How does a C corporation save you on taxes? Well, a lot of CPAs are terrified of C corporations, and they're all double taxation. You can't. Oh no, don't do that. And they're only good if you make over $200,000 a year or whatever. Such nonsense. Now, it is true that if you get paid out of a C corporation, the C corporation has to pay you either as a W-2 employee, which is the worst, or through dividends, which indeed the C corp cannot write off, and you have to pay tax on, double taxation. But don't do that. C corps have the ability, the only entity that has a flat tax of 21% up to about 12 figures. Then it gets a little different, but that's a pretty good tax system, especially if you live in a big blue state with 10% tax and your C Corp is out of state. But don't do the business in the C Corp. Have it as a holding company. A lot of people use trusts for holding companies, but what a horrible idea. Instead, use the actual entity designed to hold assets, which is a C Corporation, and then you get paid out of other entities that's underneath it. But don't make the mistake of believing that a C Corp has just double taxation and don't use it, because if you ever do sell your C Corp, each shareholder gets a minimum of $10 million of tax-free capital gains as long as they've held the shares for 5 years. It's a pretty great thing, and it's at the core of what we do.